All right, hey everyone, welcome to another episode of Visor Visionaries. I'm your host, Litan Yahav, and with me today is the one and only Travis Watts. Travis, welcome to the show. I'm super excited to have this conversation today.
Litan, thanks for the invite, man. We've met up so many times face to face at conferences and events, so it's good to collaborate here on your
Yeah,
podcast.
yeah, finally. All right, so I like to do this sort of like personal, like dive into who you are, Travis, your background. You can go as far back as you want, and then we'll take that into like where we're at today and have just a really interesting conversation.
Sure. Yeah, happy to share. I guess I'll answer that question just from the real estate perspective. So we'll go back to 2009. I had been interested in real estate, just wasn't the right time for me personally. Years leading up to that point, I had made a move out to Colorado. I was in the midst of making a decision: do I want to be a homeowner or a renter? And there's pros and cons because you got to remember we're in the midst of the Great Recession, and really there's no light at the end of the tunnel at this point. We're like mid 2009, so things are literally still falling apart all around us. So it was funny. I remember asking, because I was young and very very naive. I remember asking my friends. I remember asking parents and siblings and stuff, do you think I should buy a home? The answer was no from everybody. I didn't get one yes from anyone. And it's because of the fear, right? And it's similar to the fear in some regards that we see in 2024 and 2023. Ultimately, I decided, you know what? Real estate's on sale. It's something I've been wanting to experiment with anyway. I got to have a place to live. I'm just going to do it. And what gave me a little bit of security is really what lit the bulb for me later on. And that was this idea that I could actually instantly generate passive income on day one. And the way that I initially did that was by getting a roommate. I chose to live where I grew up. It was out in Fort Collins, Colorado, and it was a couple miles from Colorado State University. And I had just gotten out of college. And so I knew, hey, there's big demand for people that don't necessarily want to live in dorms or on site. They want to have a little more, personal life and live off site. So I got a roommate. And because of the pricing back then, and because of the small place that I bought, I paid like 95 grand for it, and I had a government credit as a first time home buyer and all this kind of stuff. It basically ended up nearly paying my entire mortgage just by having a roommate. And so from there, the wheels really started turning, and I thought, okay, this is cool. It was only like 600 bucks a month or something, but I'm like, how do I amplify this? How do I get this $600 a month times 100? You know what I mean? Like, I really want to scale up and figure this stuff out. So I read some books, did some experimenting. Again, real estate stayed on sale, at least in my market, through 2009, 10, 11, somewhat in 12. So throughout that period of time, I did fix and flips, buy and holds, got into vacation rentals later on. And again, it kind of like the epiphany hit me at a certain point. I'm like, you know what I really love about this real estate stuff is this passive income. That's, even though fix and flips are, pros and cons, and equity's nice when it happens and all that good stuff. I fell in love with the dream that I'm going to have enough passive income to actually live on, to where work becomes optional and freedom becomes the real pursuit. And that's what I ended up doing. And so by the time I reached 2015, I started to make changes in my portfolio. I started to scale away from single family homes and completely away from fix and flips and away from vacation rentals. And I decided to become a limited partner. So I decided I'm going to partner with other people in large commercial deals where these other people are truly the experts that study this stuff and they live it and they breathe it on a daily basis. Because frankly, I wasn't the best. I wasn't the best at anything I did in single family, and I wanted to partner with the best. And so that put me on a whole nother trajectory of being a full-time limited partner. So I've been on that track ever since. So all of my investments personally are limited partnerships. I do own a few, REITs and dividend paying stocks and other things, but for the most part, it's commercial real estate. And, the more I learn, the more I fall in love with this industry. Not to say we haven't had challenging times over the last couple of years. I'm sure we'll get into that in this conversation. But ultimately, I wanted to start to share this with other people. And so in 2019, I joined forces with Joe Fairless and Ashcroft Capital, and I wanted to be a voice in the industry to let other people know there's other approaches you can take to real estate besides doing it yourself and doing a fix and flip or owning single family real estate. There's, in my opinion, a much more scalable and efficient path to being an investor rather than a landlord. And so it's been my mission. It's why I've written so many articles, blogs, now a book, and why I do so many webinars and podcasts like these. I'm just trying to reach as many people as possible just to help them understand what passive income investing is all about and what benefits it might have for them.
I love that. I learned also the hard way that real estate investing cannot be passive. Now everyone thinks you go buy a few rental properties and it's passive income, but it's just so much work. It can be so much work,
Can be, yeah.
and I developed this sort of like ideology in my mind that if I'm going to invest twice the amount of time in doing something, investment, it has to generate at least twice the amount of return. And
Right.
and you know, when I same thing with you, like first few rental properties, we did the same at the same time we invested as an LP. It was like 9 years ago, and the LP deals were doing better, no work, and I'm like, why would I ever want to do this again if I can just do LP investing? And so I've also doubled down on LP investing. Obviously, you know, there's ups and downs in that, and there's its issues on its own. Where
Sure.
probably the activeness is on the front end, where you have to find good people to invest with, right? Like that's the number one challenge. Like, how did you navigate that when you started LP investing?
Yeah, it was tough. And, you know, again, I first one to admit I was new, I was naive, I didn't know. I was actually very skeptical, just to be fully transparent with you. So a couple gentlemen introduced me to this concept in the first place, this whole limited partnership, commercial. I didn't know prior to 2015 I could be a co-owner of large apartment buildings. I had no clue. I thought it was super wealthy people that owned them. I thought it was Wall Street that owned them and publicly traded stocks and all this kind of stuff. So I was naturally skeptical because I always had limiting beliefs like, well, I'm not a billionaire and I'm not a wealthy family office and a trust fund kid and all these things. But so I started slow. I started with a local group in the area that I lived with. So I was in Denver, Colorado at the time. So I just was seeking out of this little real estate group I was part of and asking around, do you know any syndicators? Do you know any of these general partners? And partnered up in a couple deals with a local group. And then I quickly realized, why partner with a local group unless they're some of the best? You know, what's the advantage of that? Because that's the whole beauty of being a limited partner. I can go find a group that specializes in Florida or in Texas or in North Carolina or in Georgia. If that's their particular niche, that's a huge advantage. And quite frankly, something that I was already becoming skeptical of in my own portfolio is owning all these single family homes in one centralized market in one state. And I got to thinking, boy, do I want to wake up one day and be 60 or 70 and have who knows how many homes all right here? What if Colorado came out with a 10% state tax? You know, what if natural disaster happened and no one wanted to live there? There's things out of our control like that. And I didn't want that much risk allocated just to one area. So, you know, that's one way of answering a question. And the more specific way is word of mouth referrals, networking, conferences like, you know, you and I last met, I think, at the Best Ever conference in Salt Lake City, getting around thousands of other investors and asking questions. You know, it takes time. It is a front-loaded business model where you have to do some research and you have to learn, you have to educate. But after you do these things for a few years, you know, it's not like you're done for life, but it certainly becomes a lot simpler to move forward at that point.
Yeah, I think once you find those good horses to bet on, the good GPs that you want to invest with,
Yeah.
diversified enough, and you take out the initial process of vetting them and going through due diligence with specific deals and the way they operate and their decks, then it's just a matter of like, you get a deal. It's a numbers game. Does this work or not? Because you don't have to vet the operator anymore because you already trust them with the way they do things, right? Um, all right. So moving on from there. Right. So you started to invest as an LP. Then you joined forces. At one point, you joined forces with the other side, the GP. Right. What made you make that transition?
Yeah, so just to be clear to your audience, so I'm not a general partner, nor do I ever intend to be one. I'm not a capital raiser either. So what I joined for is initially to help out with investor relations because that's what the business needed in 2019 because Joe Fairless was doing his longest daily running podcast in the world, the best ever investing advice. He was investor relations. He was a general partner. He was a speaker. He was, he did everything. And it was like, okay, your company is scaling rapidly. And I know this because I'm an investor with you. And I get that there's limitations to like how much time you have in a day. It's something I pay a lot of attention to is my personal time and the time of others. I'm like, let me step in and help you where you need the help. And if it works out as a great partnership, let's keep it rolling. And if it doesn't, let's call it quits. I'm not here to, leech on to some 20, 30 year, contract or something. I just let me showcase what I can do for you. And it was a win-win because I could have gone about this whole approach of educating others solely on my own, but I would be starting from complete scratch with no audience, no network, no podcast, no influence. So I got to piggyback off the already built foundation that Ashcroft Capital had to offer. So, they were already paying for sponsorships. They were already sending their employees to conferences. They were already doing this stuff. I just got to hop on the ride. And it's a win-win from a personal aspect. I get to learn and be educated and network with others. And then a win for them that they get somebody who can, help educate, develop, etc., their investor base and potentially new investors as well.
Right. I love that approach is trying to keep help and educating LPs. And I appreciate the distinction between the GP, sort of like, I understand what you mean. Like you're not a GP and I get that. And I appreciate that insight. All right. So where do you see the market of, so hold on, let's head back a second. So Ashcroft is focused on, we won't talk too much about it, but focus on multifamily, really, right? That's like the main asset class. What do you think about the other asset classes in the market?
Well, so as an LP investor, personally, I invest in, my philosophy is this: invest the most in what you know and understand the best. So for me, given my background that I shared with your audience, it was single family residential, right? So an easy leap from that was residential multifamily, right? It's really kind of the same concept, just larger scale. That being said, as much as that's kind of my bread and butter of my portfolio, I've invested in car washes and self-storage and, land plays and, note lending. There's a lot of different asset classes within commercial real estate, mobile home parks, if I didn't mention that, just to name a few examples. So generally speaking, from a macro level, I'm just a fan of the model of syndication in general. The asset class is kind of secondary. There's pros and cons. We can take mobile home parks as an example. I'm generalizing, of course, and this is my personal opinion, but the deals I've looked at and vetted, they tend to have better cash flow on mobile home parks. They tend to have less equity upside potential when it comes time to offload them or make a sale. So depending on what your goals are, specifically, if it's cash flow or if it's equity upside or if it's a combination of the two, will depend on what's best for you. But ultimately, my philosophy comes from another philosophy, which is that, the more you know and understand about something, the lower your risk can be reduced, right? So when I think back to deals I've made that were outside of real estate, where it was like some private equity venture thing that had never been done before or didn't have a proven concept or track record, I lost money in some cases. I broke even in other cases. I underperformed in some cases. That's not always the case with those. But because I really didn't know what I was doing, admittedly, the results weren't there, right? I couldn't really vet something if I didn't really understand it well. So it's kind of tied me back into just logical, common sense stuff, in my opinion, which is residential multifamily. People need places to live. A lot of Americans are priced out of the single family housing market, especially today. We've never had a larger gap on record between a new mortgage payment and apartment rents nationwide. Builders have been pulling out the last couple years, which means less supply is going to hit the market in the coming years. We're already behind, according to the National Multifamily Housing Council. They came out to say we need 4.3 million more apartment units between now and 2035. Meanwhile, developers are scaling back and not building at near the pace they were just a few years ago. So the fundamentals are in place. Okay, to me, it just makes common sense. Now, when I think about an asset class like self-storage, which I invest in, admittedly, with numerous operators, to me, it's not essential. You could argue that point and say it is. People always need it. Ups, downs, recessions, divorces, whatever. You don't really need it. You can make a decision that you're not going to have a self-storage unit. You're going to sell your crap or whatever, So I just don't buy in wholeheartedly to the philosophy that, it's here forever and Americans will always need it. I think things could change. I don't think they will in the near term, but they could.
Right. And we'll segue into the macro trends as well. But the multifamily residential space, and I think that's extremely accurate, and I agree with it. The fact that that's something that people will always need a place to sleep, and so residential and multifamily, same thing goes for mobile home parks as well, right?
Yeah. No, I mean, and in some cases, again, these are debatable topics, but it's affordable housing, isn't it? I mean, at the end of the day, and what does our country need more than anything right now is affordability, right? With all the inflation that we've seen and these stats from CNBC just did a survey. It said something like 56% of Americans don't have $1,000 emergency fund. They couldn't pay for a random expense of $1,000. We do need affordability. Right. I also like to play in that sector when it comes to residential housing. I'm not a big fan of like the ultra luxurious high rises in the downtown Manhattans or San Francisco's or Miami beaches or whatever that are going to be $5, $6, $7 a month in rent. That's not where most people are. And a lot of people kind of lose hold of those when recessions happen and whatnot, downturns, layoffs. We're seeing a lot of tech layoffs and high income jobs going away. What do? You come down to what? Affordability. So I like to be kind of in that, B plus, A minus kind of space, generally speaking, when it comes to multifamily.
Have you seen syndicators that bundle up multiple, like a portfolio of single family homes in a certain geography and hold that as they would a multifamily complex?
I've seen build to rent communities. I almost invested in one a few years ago. That's kind of a newer model because the reality is that the unfortunate reality, in my opinion, is the American dream's kind of slowly but surely drifting away, right? Having the home and the 2 cars and the whatever, 2, 3 kids and whatever. It's just getting so unaffordable, but people still want to feel that single family home kind of environment, you know what I mean? To have the yard with the fence, to go out back with the kids and have a pool or a trampoline or barbecue or whatever. So I think it's a brilliant concept. I haven't seen a deal that really, kind of did it for me, so to speak. And then to further answer your question, you've got, I'll use this example. Jeff Bezos, founder and CEO of Amazon, has backed a company called Arrived Homes, and they're buying up in kind of a crowdfunding style platform, buying single family residents across the United States where, everyday investors like you and I can partner with them. Of course, not endorsing their business or anything like that. It was just an article I was reading about. So there's creative things that are happening. There's more institutions now buying single family homes than ever before. And of course, if you happen to have a large portfolio, a lot of those groups are interested. There's been a huge migration towards real estate, especially over the last decade among the institutional players, which is kind of a newer asset type for them if you think about it, based on history. So really interesting what's happening. Obviously, it's had a big impact too on what's happened with pricing, which is the unfortunate part about that.
Right. Yeah, totally. I think one of the biggest benefits of like a multifamily play is you buy one asset that has multiple doors, and that diversifies the risk, and you consolidate all the operational aspects of maintaining all those doors And that's like the beauty of a multifamily deal. And I think that's same thing goes to a community that's a built to rent community. You you're diversified across multiple doors. Obviously, the price tag is higher because it's each one's like a piece of land and stuff. But I really like that conflict, that concept, and that's I think why multifamily is such an amazing asset class. How do you see the asset class, like a multifamily asset class, evolving over like this near short term, year to 2 years?
Here's an interesting trend that's been unfolding since 2021, and more specifically in the last year or so. And it's that more A class property is trading hands than ever before. One, because a record amount of it was built, but two, because a lot of people had high hopes for what the future looked like, post 2021. So 2021, if we back up, first of all, we'll talk about the Fed in a little bit, but if you go back and you look at a source like Bloomberg and you look at kind of the Fed funds rate and what the forecast was, rates were by December of 21 anticipated to go up, but not nearly to the amount that they did. So they were looking at something like 2%, 2.5% Fed's funds rate over the next coming years. And they ended up going to like 5.25, 5.5, right? So nearly doubling the projections. So had we all had hindsight 2020, we would have done far less deals in 21, generally speaking, right? Because you had all-time high pricing and all-time low interest rates, and kind of led to a debacle. So what we're seeing this year, and what I'm seeing as an LP, are these deals that were either the developer started in 21 and now it's complete in 23 or 24 and it's trading hands at a lower valuation than probably what they hoped for, or that a syndicator was buying in 21 and can't afford now with their short-term debt to hold on to it. So they're going to have to trade hands kind of by force, unfortunately, force a sale or go to foreclosure or whatever ends up happening with it. So we're actually at Ashcroft, we're actually buying an A-class property. It's the first that we've ever bought that's Class A. But it's amazing kind of because we're buying it at a 5.5 cap. Whereas a deal like that would have traded more like at a 3 cap in 21 potentially, and we bought it below replacement cost, which is amazing. And it's a beautiful property. It's about 12 miles from where I live. I've been to it numerous times, and deals like that were just nearly unheard of in years past. So this year, like on the flip side here, the silver lining to what we're talking about, despite the negative news headlines and the fact that interest rates going up is not a good thing, generally speaking, for values and all that, is that, we're buying a newly built property. We're not having to do the heavy unit renovations we normally have to do, and we're still getting, in our case anyway, rent premiums on top of it because they were competing, the previous owner, with new developed product in the same area. So they had to be competitive. They had to keep their rates low. They had to give concessions and free rent and all this stuff. Well, now all these properties are coming up to stabilization. Those concessions aren't going to be needed. And now you can take the rents up to the market level, something known as mark to market. It's just marking up rents to the actual market level. So it's crazy. It's like, to me, it's like an investor's dream. It's like the high quality product, and when I say high, I mentioned earlier, I'm not a big fan of like the high rises in the downtown sectors of 5, 6 grand. That's not what I'm talking about. Like rents on this property are still like, sub 2,000, around 2,000, that kind of stuff. So it's still affordable for a lot of people. In fact, the income to rent ratio is like 5-to-1 with the tenants in place on this property. So it's very affordable, more affordable, in fact, than our average income to rent ratio in our portfolio, which is more like 3-to-1, which means that a resident earns 3 times the income compared to what their rent is. So I'm stoked. I'm excited about it. It's a good news, bad news situation. But if you're someone who's been on the sidelines for the last few years, or you've got some dry powder and you're, looking to put that stuff to work, there are, in my personal opinion, as good of deals today as there were back in 2015 when I was first starting in the space before it got really saturated and very competitive. So it's kind of like a new renaissance, if you will, of this sector and just syndications in general.
Right. And that's a good segue into sort of the Fed and rates and where they're going. I've spoken with people that I think are still a little delusional. They think that rates will go back to what they used to be.
Yeah.
I mean, I think that's like totally not like that's the abnormal. Like you look at the 80s, 90s, it was like 15, 18%, and people still did deals. So the rates
Yeah.
are high. They probably will go down, but I don't think they're ever going to go down to where they used to be in the past 10 years. But what do you think is sort of like the near term in terms of like rates and the Fed and their strategy?
Well, you bring up a good point, and let's talk about that a little bit. Let's talk about, say, the 80s when a mortgage rate was 18%. Look, you can do real estate deals if interest rates are 90%. Okay, what you're going to have to do though, if that's going to be the case, is discount the price so far down to where you can still make a return on your money. Right. So yeah, if housing came down to, 5,000 bucks for a single family home,
Yeah,
give me a 90% loan. You know what I mean?
yeah,
So that's the thing that you have to remember. And you're right. I mean, we're just kind of in a normal range anyway, and everyone's making such a huge hype about, high interest rates when historically they're not. But what has changed is the national debt's never been this high in US history, right? So try taking $34 trillion and putting a 5% interest rate on it. It's ugly. It's ugly. And it was never like that in past years. The stimulus stuff has changed, but think about it this way. The Fed is controlling, the rates largely speaking, right? Well, think about this. To like either help the economy or slow down the economy, they really have one tool. you know,
yeah.
their tool is this lever that's either like increase rates, decrease rates. So it's been a long time since we've had a really big, nasty recession. I mean, really, that was 08, 09, really. I mean, you could argue the onset of the pandemic or whatever, little minor crash of 22, but like really, it was the Great Recession. So the Fed needs to have rates elevated in order to have some kind of tool to use to stimulate the economy if it happens, right? If they drop rates all the way down to your point right now, tomorrow at zero again, and then we go into recession, they look like fools. They can't do anything to help the economy. All we could do is print more money and give more stimulus. But this is kind of the cycle that we tend to go through, isn't it? Quantitative easing and now inflation and now raising rates, and then we lower rates if we start going in recession. We're starting to see some cracks in the economy right now. I don't know if we're going to go into a nasty recession. I sure hope not for everybody's sake. But the one silver lining to it would be that it would be more likely the Fed would aggressively cut rates, in which case it would actually help commercial real estate. But, I don't wish it upon anyone. I'm not predicting anything, not a financial advisor, yada, yada. But it'll be interesting to see how next year unfolds for sure. I was just reading, actually, Reuters did a survey and a poll, and they said that the market's pricing in a 70% probability of a rate cut in September. I was reading another poll from the Fed Funds Futures. They have a 95% probability on a rate cut in September of 24. But these rate cuts are anticipated to be rather slow to start, 25 basis points or something like that. Honestly, a 25 basis point cut, even if it happens, is not going to be life-changing for anybody. It's really not going to change anything, except for it may give some positive sentiment to the market to say, okay, finally, we are actually cutting rates, right? Hopefully, we're on the track now. We're on the path of downward momentum as far as interest rates go. Other than that, I mean, to save commercial real estate in its current state, who knows, man? You probably need 150 basis points to 200 basis points for things to really, get progressively better fast.
I was talking with some developers the other day, the single family developers, and it's funny because they've seen mortgage rates drop a bit, and that dropping a little has changed their market. Suddenly, there are more buyers in the market now, which
Right.
it's exactly to your point of this momentum, because it's crazy because we were at that point a while ago and you didn't see buyers because there was an upward momentum and people were like, the benchmark was zero and now it's at 6%. Hell no, I'm not going to buy it. But then it went up to 6.5%. Now it's going back down a bit and now they're buying. And so it's like such a psychological aspect. It's like everything has been stabilized around high interest rates. Now if it goes down, even it goes down a bit, 100 basis points. I feel like if it goes down 100 basis points and stables there, there's going to be a frenzy of buying. Like just people are going to start buying again just because Yeah, well, it went down a bit.
Yeah.
It's such exciting. There's so much psychology in this world of investing and when to buy, because the numbers will work in any. There will always be deals that pencil out, even though market interest rates went up. Right? You're always going to find deals.
Yeah.
Um,
Yeah.
and so yeah, I mean, yeah, I think it's super interesting psychology around finance in general and interest rates particularly.
I find it fascinating to listen to the different talking heads in the industry, right? The gurus and the people who have really truly been around for decades and decades and decades. I was listening to Barbara Cochran, Shark Tank real estate investor lady, and she's like, don't wait on rates to go lower because that $500,000 home becomes a $600,000 home when that happens. So when you look at it from a payment standpoint, like it's still going to be roughly the same, if not more, than what it is today. What you can do instead is buy at today's valuation and then refinance later if rates do go down. Interesting perspective. I think I'm more in that camp than of the camp of the folks saying we're going to have another 2008, 9, 10 again. There's not the fundamentals to support it. We're not giving out those ninja loans, no income, no job verification. Everybody gets a house, just go to your local bank and we'll give you a mortgage. Stuff's not happening. You have to be highly qualified in today's market and over the last several years to be buying anyway. So, and having substantial down payments, and banks got a lot smarter, and rightfully so after 08, 09. They had to put some things in place to not make the same mistake again. So I'm not too concerned about it. Could we see a softening in single family? Sure. I don't think, 30, 40, 50% down. No, I think, maybe 10%. Depends on the market. But again, I don't have a crystal ball, so don't listen to me and my forecast. But
Yeah, I 100% agree, because I think if you buy a home today and interest rates go up, you made a smart decision. If you buy a home today and interest rates go down, you refinance and you made a good decision. Like you should not buy a home based on if the interest rates go up or down. You should buy a home because it's a good deal for you to buy a home, right? I think
yeah.
I totally agree with that. Yeah.
But also, just to add one thing to that, so there's still this huge thing. Again, we talked a little bit about the American dream and kind of my 2 cents on that. There's so many people still buying into that, like it has to be the case. Like if I don't become a homeowner, I see this a lot in 20 somethings and early 30s. You don't have to be a homeowner. Like it's a psychological thing. It's a marketing thing. At the end of the day, you got to do what's right for you. And there were several instances throughout my journey that I became a non-homeowner on purpose. Not because I couldn't afford it, not because I lost a house. Okay, I moved to a particular area that either A, I didn't know if I was going to stay in that area, so it wouldn't have been smart to buy, or B, I felt like everything was way overpriced compared to the rental market. I'll give you a practical example. Downtown Denver, my wife and I, before we had our son, we rented an apartment straight in like prime time high rise downtown for like $2,000 a month. If we would have bought the same size condo in the same type of building, it would have probably been $1 million. So like the numbers just didn't add up. It made sense for us to rent. And I'm so glad that we did. We didn't have the HOAs and all the other crap that goes along with this. So it's not always a good decision, but then when we travel to Oklahoma and see these homes for 200 grand that are brand new, I'm like, whoa, maybe I'd be a homeowner there.
Well, I mean, I think it's like one of the oldest debates, and I'm on one side of the camp. I think that being a homeowner, like buying a house and living in it, is like vast majority of the time not the smart financial decision. If you have the money to buy a home, go invest it and buy 2 other homes and rent them out and rent where you live, right? From a financial standpoint, I mean, obviously there's psychological impact, and my wife and I have had arguments about that. She wants the stability of living in the home that's ours and putting a nail in the wall that's ours. And for me, it's like, no, I'll just have an agreement with the landlord, a long-term agreement, and I'll treat the house like it's mine. I'm renting it. Who cares? And so it's like, it's always that debate.
Well, let's talk about that for a minute, because that's an interesting topic. So This is one thing I also like about the B plus A minus sector of multifamily. There's a great case to be made for this segment, and a lot's changed from the 70s and 80s, back when it was like, oh, you're a renter, because obviously you can't afford to buy a home. That's not the case today. So many people rent based off lifestyle preference. Let me paint the picture for what we had in that $2,000 a month downtown apartment. We had a walkout balcony view of the entire city's skyline. We had a pool. We had a hot tub. We had an exceptional first-class gym. We had, resident events and catered food coming in, and we didn't have to shovel snow, and we had a parking spot and no cleanup and no maintenance. If our washer and dryer broke, the maintenance team came and just gave us a new one or fixed it, not out of my pocket. No HOAs. I mean, there was some advantages to this. You know what I mean? And what I like to say is that your rent is the max you're going to pay every month, but your mortgage is the minimum. It's a lot to think about, man. We just went through a stupid little rehab on our home and cost almost $5,000 and almost nothing got done. It was like, to me, I just felt completely ripped off. So there's a case to be made. Going back to the stat from CNBC of 56% of Americans don't have a $1,000 surplus reserve fund. If you're in that camp, well, maybe home ownership should wait a while because undoubtedly that $1,000 is going to go like that, the first time you walk into Home Goods or something.
Right. I agree. All right, man, this is a super interesting conversation. I really appreciate you coming on. Is there anything else you want to add sort of to sum it up?
In summary, from my personal perspective and opinion, just to reiterate, I'm seeing amazing opportunities this year, and this is because as rates have gone up, prices have come down in the commercial space. And in many instances of deals that I've looked at, including ours at Ashcroft Capital, we're buying below replacement cost. And that's really an important consideration to think about. And I would encourage your listeners to look at some of the forecasts. I put together, for example, a quarterly market report. You can find it at ashcroftcapital.com. And what I do in this report is I pull sources from the U.S. Census Bureau and from CoStar and from Marcus and Millichap and from CBRE and from U-Haul stats. I try to get as many reputable sources and I try to pile them together as most recent as I can find. And then I let you, the reader, decide. I'm not here to tell you what's going on. I'm just showcasing other people's reports. But you can get a really good indication based on history, the current status, and what these folks are saying as a forecast, which we always have to take with a grain of salt, but it gives you a really good indication of kind of where we're at. And the way I see it, we're in the bottoming out, if we haven't already, of a market cycle in commercial. And, again, we all know, be fearful when others are greedy, greedy when others are fearful, buy the dip, dollar cost average. We know these things, and it's just hard to do psychologically. So I'd encourage your listeners to, if you're in a position to invest, to really consider a year like this, to look at deals and at least educate yourself at bare minimum.
That's amazing advice. I appreciate it. Thank you, Travis, for coming on. That's it. Signing off here. Thank you so much for joining us. And until next time, keep investing wisely and passively.